Now, a reminder, we are going to review a debt payoff process. We're not going to be reviewing how to invest your money, consolidating debt for a fee, or refinancing debt. We're going to be in the debt payoff business, okay? Something I want to bring to your attention. For those of you that have been working with a financial advisor for a decade plus, if I was to ask you to put your hands on the debt elimination strategy your advisor put in place, I'm almost 100% certain that nobody on the call is going to be able to do that. Why? Because financial advisors don't specialize in debt payoff or debt elimination for their clients. Financial advisors, what they do is they put a plan in place for their clients that's an accumulation of money plan for their financial future, and then to hopefully use that money in retirement. Okay. Again, if I asked any of you that work with financial advisors to go put your hands on a debt payoff process they put in place, I know you're not going to be able to put your hands on one. Any plan that you'll put your hands on has to do with accumulating money. So what's my point? It's this one. As I go along here and show you examples of clients using our debt payoff process, what I want you to think about is, do you prefer the financial position that you're sitting in today, or would you trade it all to be absolutely debt-free, including no mortgage? And the reason I want you to kick that around is because if Sheena and I had the opportunity to work with you for the past decade plus, most, if not all of you, would have been completely debt-free more than likely 2 years ago. So that means that the majority of our clients, 95 plus, are debt-free with our process in less than a decade. Okay. So let's take a look at the first type of client that we've helped. Okay. And it's a younger family named Mark and Joyce. They're in their mid-30s. They're making $7,000 a month. They got 3 kids under 10. And there's a lot of common areas of interest. As a matter of fact, I'm a 51-year-old fella, and my babies are 23 and 25. So as far as my areas of interest, everything but the college planning would interest me at 51 because my kids are already past college age. All right. Couple of little items for you to think about. Don't focus on the ages of my clients, or our clients, I should say, and don't get overly concerned on the income that our clients make, because I'm going to show you this young family. Then I'm going to show you somebody closer to retirement, late 50s, early 60s. And then I'm going to show you a high income earning professional who's in her early 40s. What I want you to focus on are the benefits that our debt-free process is providing these families. Because regardless of age or income, when you take a look and see how this young family here, because this young family, they're brand new and saving money like a lot of young people are. And in this case, this family only has $180,000 of debt, including the mortgage. Okay. I know some of you on the call, you've got 280, 480, 780. Some people we work with have a million plus of debt. Again, I'm beating a dead horse and repeating myself. The focus is in how our strategy handles the debt that these clients have. Don't get hung up on age or income, because it works for all levels. Okay. If our client could write a check for their debt, one check, they'd be debt-free. But I think we can all agree most Americans aren't doing that. They can't do it. They're paying their debt over time. And because they're paying their debt over time, they're going to send a boatload more interest back to the lender above what they borrowed. Now, 30 years from now, these folks, they don't use Sheena and I's process. They continue to do things their way. And 30 years from now, they're completely debt-free. They don't owe anybody a dime, and they have money that's accumulated in their retirement plan. Or take a look at this. Using our payoff process, they're debt-free really fast. Matter of fact, 3 times faster than they were on track for. saved a boatload of money. So even with that type of that type of debt, which I think for a lot of Americans, that's a low amount. I think for most Americans, when they take their debt, including their mortgage, into account, they've got a lot more debt than 180. So look what this family saved with just a 180 of debt. Now the 2177, that money used to leave their checking account every month and pay the mortgage, the car, and the other debts. Now here they are. They're age 45 and 43. They owe nobody a dime. And they now have a choice what to do with the 2177. They could spend it. They could buy more stuff like four-wheelers or boats or RVs, or they could just simply choose to save the money. Remember, in our process, we're not about investing. Investing requires you to take risk with your money, and Sheena and I are not against it. However, our process is just about setting the money aside safely. And look at this. In that same period of time, look what they've accumulated. Okay. Now, I'm confident everybody on this call can do math. You know that we're several $100,000 better with our debt payoff process than the way they were doing things. So how did we do it? Well, you remember just a few minutes ago, I talked about everybody that's interested having the ability to have a side-by-side report prepared, showing you how our debt payoff process compares to the one you're doing now. Well, I'm going to review a few of these reports, okay? And what you're going to see, and more importantly, what the reports are going to verify, is why our clients are choosing to add an additional financial institution's contract to coordinate with their checking account contract that they set up at the bank to become debt-free 2 to 3 times faster than they're on track for. And more importantly, as a result of using our process, our clients are going to have more money and benefits. So now, everyone, let's take a look at why our clients are choosing to add a permanent life insurance contract to their payoff process. And what you're also going to see is why this has nothing to do with life insurance in its traditional sense. Okay. Now, these reports have a lot of numbers and they can be a little busy. However, if you stay with my explanation and follow along with my cursor, I believe I'm going to give you clarity and answer all your questions before we get off the call here. So remember to provide the report. We needed to get financial data from our potential client. We needed to know their debt numbers, so the dollar amount they owe, the interest rate they're paying, and the payments they make. And then we need to understand where they're keeping money: bank, brokerage, IRA, 401k, etc. We got that information from these folks. We did the analysis. And here on the bottom is all of their debt. Okay. And this number here, this is the dollar. These are the dollars that we identified through our analysis that this family could run through our strategy. Now, a couple of things. $625 a month, that is nobody's dollar amount on this call. Sheena and I have no idea what your dollar amount is until you allow us to run the report for you. Okay. But this should, what I say next should put a smile on your face. Whatever dollar amount Sheena and I find or identify, you have to agree to. This is not our plan. This is your plan. And by the way, if you decide to get your report, and when you review it, I'm going to use a little cliche here. If you get your report and when you review it, if it does not, and I'll repeat those words, if it does not feel like slipping on your favorite pair of shoes, to use that analogy, Sheena and I are going to be right in line telling you our program isn't right for you. Okay. It's right for most, but it ain't right for everybody. By the way, where did we find the $625 for money to run through this insurance contract? We found it in 2 places. Number 1, in our payoff process, our clients do not make extra payments towards their debt directly. They continue to make the minimum payments. Any extra money they were sending to the debt's lender they're going to run that through their new insurance contract first. And we found that Mark and Joyce were overpaying their minimum payments by $325 a month. Where did we find the other 300? Well, I'm fairly confident everybody on this call either has heard or is already doing this, and that is having about 6 months of your earnings safely tucked away in a savings account, so that if something bad happens to your job or another financial emergency occurs in your life, that you've got money to deal with it. Well, our clients were saving $300 a month for that purpose. And what you're going to see here in just a minute is that we build liquidity into our payoff process, so that if our clients need to stop their debt payoff because of another need for money, they have money to do so. Okay. So this is total debt versus real debt. Total debt, ladies and gentlemen, is if a client could write a check today for the debt they owe. The real debt is the interest on top of what they borrowed that they're really going to pay back. So let's take a look at the first page here that gives you more details on how our process works. Okay. Reason number one. This isn't about life insurance, and I'm going to move this here. Reason number one, this is not about life insurance in its traditional sense, is because we are not trying to replace anybody's income earning value back to their family. Okay. This isn't about saying, well, you make $100,000 a year and a good rule of thumb is to leave your family 10 to 15 times as much as you earn. That's not why we're here. Okay. We're here to show you the benefits of using a permanent life insurance contract to run money through over just the bank. This contract is a superior financial institution's contract over the bank to become debt-free. So that's where I want your focus. All right. By the way, in the case of a married couple, if I don't remember to say this, Sheena always reminds me, in the case of a married couple, sometimes the higher income earner of the spouses is less healthy. Guess what? We don't use that spouse to put the insurance contract on. We use the other spouse because, again, this has nothing to do with life insurance in its traditional sense. And that'll make more sense as we go along here. All righty. So what does our report show you? It shows you your way of paying off your debt, our way of paying off the debt, and the interest you save. Now, I think what I'm going to say next is awesome. We're not in the guessing game business. Our report will show you exactly when you're going to have money available in your contract to lump sum pay every one of these debts. Okay, so here we go. Insurance contract is in place. The $625 is the amount of money this family is sending off to the insurance company every single month. Now, as soon as there's money available in this insurance contract to pay off this little baby Visa bill, and by the way, that answers the first question. How fast will I be paying off my debts? Well, very specifically, your report's not only going to tell you when it's all gone, but it's going to tell you when money's available to handle each one. And some of you on this call, heck, we might be showing you how to pay off your first debt in just a few weeks after starting this process. Okay. Let me dig down a little deeper. The majority of our clients have everything paid off but their mortgage debt in less than 3 years and their mortgage in less than 9. That's most people. So our report shows you when you can be debt-free with our process, how much interest you save, and the time frame when you're going to pay off debt. So let me get a little more specific. You see this first Visa bill. When there's money available, the Visa bill still has $359 of balance on it. So what is our client going to do to get the money out of their insurance contract to lump sum pay their first debt? This is neat. Our clients use an awesome contract provision that permanent insurance has. And that contract provision is the ability to use other people's money, or in this case, the insurance company's money to pay off debt. So what our clients do is they keep their money in their insurance contract earning benefits. And they also use their money in their contract as collateral for the insurance company to send us their money. In other words, our clients take a policy loan. Okay. And it's very easy to get it. It's an administrative form to the insurance company. The insurance company processes it and sends the money that is needed right back to our client's checking account. And then what do our clients do with that money? They lump sum pay their debts, financial institution. So in this case, it was just a little baby bill, $359. Now, see this minimum payment that was going to Visa's financial institution? Now that it's gone, where do you think we want our clients to send the $55? Now, most, if not all of you said, well, Mike, we're going to use that $55 and we're going to roll up or snowball it next to our next debt. And that's close. What you're going to do first is, now that the Visa bill is gone, when that $55 goes into your checking account next month, because it's coming from your earnings, rather than you keep it in your checking account, we're going to have you send the $55 back to your new insurance contract, okay, to replenish that account. And then take a look at this. Here in month 5 for this family, money's available again. So we're going to go through the same policy loan process, get the money out of the contract, send it back to the bank account, and we're going to lump sum pay off the next bill. Once that bill's paid, the minimum payment is going to go where? Back to your insurance contract. So for a little summary where we're at, we have $625 going to the insurance contract in what's called premium or premium deposit. Then after this first bill is paid, in addition to the $625 going to the insurance contract, we've got another $55. Then when the next bill's paid, another $255. And that will continue as we're paying off the debt. And take a look here. This is neat. Within a year and a half, this family has everything paid off but their mortgage, freeing up $1,200 of monthly obligation. Let me give you another little a metaphor to make more, even more sense, or really to show you the benefits. Imagine this family put this plan in place back in 2018, maybe even early 2019. And then the COVID pandemic hit us in 2020, about a year and a half later. Don't all of you agree that this family, having $1,200 less in financial obligation, has either reduced or eliminated the financial anxiety in that household? I think all of you would agree. Sheena and I are pro-investing, but putting that $1,200 a month in an IRA, a 401k, Roth IRA, buying crypto or real estate, that's all fine and dandy. But doing that did not provide these benefits for the client, did it? Okay. I need you to focus on that $1,200 for a minute, because I'm going to bring it up again and show you another reason this has nothing to do with insurance in its traditional sense. Okay. By the way, a lot of people ask Sheena and I how we get paid. And I want to remind you of something. You know, when you go to your bank and you set up your checking and savings accounts, you know how the bank pays the bank employee who's assisting you in opening up your accounts? You know how the bank pays them? Well, guess what? In this scenario, the insurance company pays Sheena and I to put these contracts in place. Our clients don't pay us an additional fee to get it done. Give you a quick summary. Here it goes. Our clients put the new financial contract in place. They send money to the insurance institution. As soon as money is available to pay off your first debt, you're going to get money out of your contract. It's going to be direct deposited right into your checking account, and then you'll lump sum pay your debt in the order that's on your report. When you've paid off the debt, what you do with the money that used to go to the debt's financial institution, or in other words, what you do with the minimum payment now that the debt isn't there, is rather than keeping it in your checking account, you send the money to your life insurance contract. And that's exactly what I've just explained there. Here's the ledger, lots of numbers, but stay with me, it's easy. We're going to go left to right. I'm going to explain what these columns are, very easy. I think everybody on this meeting or on this call, I think you've all seen a financial illustration. And that's all this is on the left-hand side. These numbers are Mark and Joyce's financial illustration. When you decide to get your report, these will be your numbers. The middle is the administration of our payoff process, taking money from the insurance cash value, taking it out, see how the numbers are lower at the end of the year. Why are the numbers lower? Because this is easy, because the minimum payments that used to leave this client's bank account to go pay the debt are now going back to the client's financial institution to free up more money to use again. The far right column, this is showing our clients their liquidity as they're paying off debt. Here's a couple of other neat items about this payoff process. We only illustrate, I'll repeat that, Sheena and I only illustrate to our clients them using 85% of the money available to pay off debt. We keep 15% in reserve just in case our clients need to stop their payoff process and they need to spend money on either a financial emergency. And I think we can all agree a financial emergency is anything to do with our or our family's health or well-being. What's the other E? It's emotional spending. And another way to define emotional spending is called retail therapy. Okay. The point is we build liquidity into our process in case our clients need to do something else with their money other than pay off debt. Right. By the way, see this column over here? It's called savings balance, or another way to say what this column is this is money outside of your insurance contract. What I'm going to say next is wonderful. All of our clients reach a position where they can no longer put what I call their roll-up money. And their roll-up money is an accumulation of the minimum payments that used to go pay the debt. And remember, once we pay the debt, we want that money to go to their contract to fill it up again. Well, once that contract is filled up, our clients, in this case, remember that $1,200, they can't put the $1,200 in their contract anymore. They could put the $625 a month, but there's no room for the $1,200. So our clients, hear this, our clients need another financial account to put the $1,200 in. And I think all of you are going to love this. This account doesn't need to pay more than a 2% rate of return, which we can get every day of the week now. Okay. So remember, I said this wasn't about investing. This was about certainty. Okay. So there's an explanation of all these columns. Let me fill in some gaps. The gold lines here show our clients when they're paying off debt. So here is everything but the mortgage. And then right here before year 8, the mortgage is paid off, or the option to pay off the mortgage if for some reason they didn't want it. But people we work with don't want a mortgage payment anymore. Imagine being 45 and 43, owing nobody a dime, including no mortgage. And to make a little bit more impact on that statement or question, I should say, you know, somebody asked this family here, if they ask Mark and Joyce at 45 and 43, they say, how much is your home worth? And let's say, for example, they say 600,000. I hope all of you know that when somebody asks you the value of your home and you have no mortgage due on it, whatever value you tell them is all your money. And I hope you find that reason to celebrate, because here are our clients, Mark and Joyce, they owe nobody a dime. They've got 100% equity in all their assets, including their home, which is at least 500,000. Everybody asks me this question next. Hey, Mike. Hey, Sheena. Now that we're debt free, do we have to keep this contract anymore? And the answer is no. Okay. And if our clients decided to cancel their insurance contract, remember, they're debt free 3 times faster than their plan had them out of debt. And if they don't want to use this contract anymore, we'll give them a 5-figure check and their plan's over. So benefit number 1 of our process is debt free faster than yours. Benefit number 2. Okay. This is where you're going to start seeing hearing and seeing the other benefits. Longevity is not guaranteed in our country. As a matter of fact, 1 out of 4 Americans does not live past the age of 65. I can give you some reasonably well-known and recent deaths. Bob Saget, the comedian, and Eddie Van Halen lived to age 65. Prince and Michael Jackson, the entertainers, lived to 55. Elvis, I only bring up Elvis because, number 1, a lot of people know who he is. And secondly, just a few months ago, there was a movie about Elvis that was pretty popular. Elvis only lived to 42. And Kobe Bryant, the famous basketball player, and his daughter, they lived to only 41 and 15. Bad things happen to good people all the time. And look at this. If something bad happened to our client here, notice we've got enough money to self-complete the debt payoff process. Remember, this is not about life insurance in its traditional sense, because if it was, we'd be recommending 8 to 10 times this amount of money if this was about life insurance. It isn't. The next benefit, I've got a little humor with some seriousness. Most of us don't die the first time we try. We can be kept alive, can't we, by our medical profession? But being kept alive, especially after a bad accident or illness, being kept alive many times means we need help with feeding us, bathing us, getting us dressed, using the toilet, moving us around, or some of us could have cognitive impairment. And what I just listed there, those items, they're called activities of daily living in the medical and financial services world. And those items I described, losing the ability to do those items for yourself, the ability to feed, dress, use a toilet, etc. Having the ability to do those items or tasks for yourself is what generates the most common form of long-term care costs. In other words, when you can't perform activities of daily living, what all of our clients find fantastic is if you lose the ability to perform 2 of those, 24% of this dollar amount, 24% a year times 4 years, or almost all of this money can be paid out ahead of time to somebody you trust, like a spouse or another family member, and help use that money to cover care costs. Next benefit, our contracts paying over 200% better interest than most banks with no 1099. Also, in the majority of the states across our country, money inside this contract is judgment proof via your state of residence's actual laws. Okay. So as you can see and hear, in addition to paying the debt off, in this case, 3 times faster, look at the multiple benefits our clients are receiving by just choosing to add one more financial institution's contract to their debt payoff process. Sheena and I both recommend, if you're liking what you see, get your report and know exactly how your process works before you decide to cross this debt payoff journey with our system. Okay, 2 more cases to show you. Here's a 61-year-old couple, all right, making fine money, driving the cars they want to drive, living in the neighborhood they want to live in, but they still owe a boatload of money on everything. And there's a lot of 61-year-old people like this across our nation. They look good. They're having even a vacation every year, but they still got a lot of debt service, which is keeping them from retiring. If you'll notice, it's going to take them 24 years to pay off their debt their way. Okay. We did the same education that we've shown you today. We identified $700 a month. Okay. $700 a month this client could run through the process. And everybody remember, These dollar amounts, these other folks are running through the contract. They are not your premium amounts. Okay. They're these folks. You know what yours is after we do the analysis. $700 a month rather than being debt free in 24 years. Check this out. 9.3. These folks were ecstatic because we had them debt free just a little bit past age 70. And what's significant about age 70 today financially is our Social Security income will never grow any larger once we hit age 70. I think everybody knows at age 62, you have a reduced amount that you can get. I would think most people on the call today, you won't be able to get your first full level of Social Security until you're 66. And then everybody on this call, your benefit will max out at age 70. Okay. Imagine hitting age 70, hanging up your work shoes, you're going to retire, and having no debt service at all, including no mortgage. How much better does your Social Security income, along with money that can be supplemented from your savings and investing, how much better does all of it spend when you have no debt service? Okay. Last one, high income earner here. This is a doctor. She's making $750,000 a year minimum. Here's her debt. She has 4 properties. Okay. She happens to be out in Arizona. There's a couple of vacation properties, a building, and her residence. Her making regular mortgage payments, she'll be debt-free in just under 23 years. However, here's what we learned. After I showed her this payoff, she told me, she said, "Hey, Mike, not only am I making the regular mortgage payments, but I'm overpaying all my mortgages by a total of $5,000 a month or $60,000 a year." Okay. Now I know everybody can't do this, but the high income earners can. And by the way, why is she making these extra mortgage payments? For one reason, she wants to be completely mortgage free in the worst way. Okay. She wants it done faster. Her accountant and financial advisor, they're trying to tell her to put this money in a retirement plan where she can get a tax deduction today. And she goes, "Mike, they don't get me. I don't want to defer my tax obligation to the future. What's more important to me is I want no debt service right now. That's important to me. I want this financial outlay to go away." So here's what we know. We know that our debt payoff process will have her debt free in 8.9 years. But hear this. We ran another calculation, and what we learned is that her paying more money to the lender would have her debt free in 8.7 years, 2 months quicker. So why did she choose to work with our process? Here's why. Because with the same money, her paying the lender directly did not provide her with $2.4 million of self-completion money. With her paid the lender directly, she did not have $250,000 annually for 4 years, or almost $1 million, to help cover costs associated with her losing the ability to perform those activities of daily living, eating, sleeping, bathing, dressing, etc. With her pay the lender directly that amount of money, she gave up liquidity. Because I hope all of you know on this call that if you're sending more money directly to a lender and you get yourself into a financial tight situation, I hope all of you know that you can't call the lender and say, "Not only have I been a great borrower and been early, I've been a day early with the minimum payments, I've been sending you lots extra. And the problem I'm having is I got into a bad way financially and I need to get some of the extra payments back." Financial institutions don't send you extras back because it's no longer your money. Okay. By the way, as I mentioned earlier, money in this contract in most states across our country is litigation proof. And any professional that generates liability through their own career really likes that asset protection because it's your own state law that gives it to you. Look at this. If our doctor here doesn't want to have this contract anymore, she is debt free at roughly the same period of time as she was debt-free on her own. However, in addition to all of those benefits that she had, why she had the contract, if she decided that she didn't want to do this anymore, she'll get a 6-figure check and she's done. Okay. Or she can keep this contract and she could use it for her financial future, whether it's using it to buy more real estate or supplementing it for income during her retirement. Lots of people use it to build up money to make a future purchase. We're showing clients the advantage of using this contract to pay off all your debt. And then Sheena would tell you this as well. And then our clients turn this into their own banking contract. And now they build up money to self-finance future purchases like a car or real estate. So we have people going from being in debt to no debt, and then using the same money to acquire assets and continue to build their financial future. When you see your report, the numbers are the net numbers. There's no smoke and mirrors, okay? Our report has our clients debt-free when it says you'll be debt-free. There's no ifs, ands, or buts. You follow the steps, you get the results. So with that, what I'd like all of you to consider is having us prepare your report for you. That'll give you the side-by-side comparison on how your debt payoff process compares to ours. And please remember, this is a complimentary report we're providing you. And once you review it, there's going to be no doubt. You're either going to say to Sheena, let's move forward with this process, or if you review your report, you're going to look at it and say, nah, it doesn't look right for me. Okay? So for those of you that are interested, Sheena's going to follow up. Thank you for your time, and just ask if you want your report. And if you do, she's going to send you a data form to complete with your numbers. And as soon as you have that done, return it to her. And we'll need 48 hours to turn around the report. But when we review it with you, it'll be in a process just like this.